Hello and welcome to the JuniorMarkets YouTube page. If you're tuning in from YouTube, make sure to check out our website. That's what I'm looking at right now in investing under the metrics tab. And the goal for today's video is to go over part 2 of the metrics video that I uploaded a couple days ago. So today what we're going to be going over is price to earnings, price to sales, price to book, price to cash flow, price to earnings growth ratio, and the beta. So when it comes to Smith presentations, when we have to build presentations and reports to present a stock to the firm, these are the ratios that our professors love to look for in the metrics table, no matter what industry it is or no matter what company it is. These aren't necessarily industry specific, although they do have industry specific measures. So some industries might be higher than others. That's why you have to compare them to companies in the same industry. You should use these metrics across the board. So first, let's start off with one that pretty much every investor, beginner, intermediate, no matter what you are, what every investor knows, and that is the price to earnings ratio. So essentially what this is it shows how much investors are willing to pay for each dollar of a company's earnings. So in another way, the higher the ratio, the more expensive a stock is relative to its earnings. And so this is important because most of the time, beginner investors look at price to earnings ratio first. And a high price to earnings ratio means that investors are expecting either very high growth, such as Amazon with a PE of 60, or the company has lower PE with the S&P 500 average being about 17. So you have to look at these and then you have to compare them to other companies in the same industry. And then you have to take into account if these companies are growing, if they're in a growth phase, or if they're more mature. So companies like Apple would have a lower PE because they're more mature. Now, if you're using the PE ratio, you also want to use the forward PE ratio. So the current PE ratio is found by taking the stock price and dividing it by the earnings per share, and we have that listed up here. So it's taking the stock price divided by earnings per share. And then if you want to find the forward PE, then you take the stock price and you divide it by the forward-looking earnings per share, so the expected earnings. And you want to make sure that the forward PE is lower than the current PE, because that means that the earnings are expected to grow for the company going forward. We'll look more into this when we hop over on Schwab's website and we look at this more in depth. So the next one that we're going to be looking at is price to sales. So I have price to sales on here. Where is it? Here it is, price to sales. Right here. So price to sales, essentially what it is it measures how much investors are willing to pay for each dollar of a company's revenue. So it's calculated by taking the market cap of the company and dividing it by the total sales revenue over the past 12 months. So share price divided by revenue per share trailing 12 months. And this is used obviously to compare companies in the same industry. And so what investors use the PS ratio for is companies that don't have. This can be useful for companies that don't have positive earnings, like startups or high growth companies, because PE ratio wouldn't really work because they either have negative earnings or their earnings are very small, and so it's a bad way to look at the company. So it focuses purely on sales, and so a low PS ratio might suggest that the stock is undervalued, and or it could suggest the company is struggling to generate sales. And then a high PS ratio, which is above, say, 3 or 4, could indicate that a stock is overvalued or that investors expect future growth in revenue. And so we'll look more at that, obviously, when we go to the company comparison. So next up is price to book, which I have listed directly under that. So this compares the stock's current price to the net worth of the company's assets. So this is essentially, that's where the book comes in. So the price is the current stock price, and then the book is the assets. So this is calculated by dividing the company's market price per share by its book value per share. And then you can look up how to find the book value per share. It's essentially assets minus liabilities divided by shares outstanding. And then the lower the multiple, the better, obviously. And PB ratio below 1 or equal to 1 might suggest that a stock is undervalued. And this is because the company is worth more based on its assets than the market value. And a price to book ratio above 1 indicates that investors are paying more than the company's book value, which could mean the stock obviously is overvalued, or that investors expect high future growth because you're paying more for the stock than they essentially have in the book assets. And then moving on, we're going to move into price to cash flow, which I don't have on here. So we'll quickly go over that. So stock price, this is calculated by taking the stock price and then dividing it by the cash flow per share. And essentially what this is the net amount of cash a company generates from its business operations, which is the cash flow, divided by the stock price. And this compares a company's stock price to its cash flow. It helps investors assess how much they're paying for each dollar of cash flow generated by the company. So a low price to cash flow, below 10 is the industry standard, might suggest that the stock is undervalued. And then a high price to cash flow might indicate that the stock is overvalued, so over 10. And then this valuation obviously has some limitations because it's current cash flow, and so it doesn't predict into future growth. So it's more just looking at the company currently. And then moving into price to earnings growth ratio, which is taken with the PE ratio dividing by the earnings growth rate. And if this essentially is a valuation metric that builds on the PE ratio, and it takes into account the company's earnings growth, and it's used to determine whether a stock is undervalued or overvalued relative to its earnings growth potential. So if a company has a PE ratio of 10 and is expected to grow earnings by 10% per year, the PEG ratio would be 2. And this means that investors are paying $2 for every percentage point of future earnings growth. So a PEG ratio below 1 might indicate that a stock is undervalued, and then vice versa. If it's over 1, it might be overvalued. And then hopping into the last one, which is the beta, which I do have on here. So beta is the measure of a stock's volatility relative to the S&P 500. So I have a part in this website that goes over what the S&P 500 is, but essentially it's just the 500 biggest companies on the stock market by market cap. And the S&P 500 has a beta of 1. So any beta higher than 1 means the stock is more volatile than the market as a whole. And then vice versa, if it's less than 1, then it's less volatile than the market. So if you're looking for a more of a risky investment, then you would go over 1, and that's normally more growth stocks. And then if you're looking for something that is more stable, like utilities, then you might go for something under 1. And now let's head over to Schwab's website where we can look at these metrics in action. So I pulled up a stock that I did a YouTube video on, Yum China Holdings, which essentially is just a restaurant company over in China. They own some things like Taco Bell and KFC. And so let's go down. So first, we can see that the price to earnings is 16. And this essentially means that investors are willing to pay 16 times the company's earnings for each share. And so it's below some of its other competitors. It's below most of its competitors that Schwab put. And so this is a good thing. This means that the company has a relatively better earnings. And then if we look at the price forecasted, we can see that it's lower than the price to earnings now. And so that's a good thing. That means earnings are expected to grow. And then next up is price to sales, which is 1.18. And if we remember from what we talked about, price to sales is a measurement of how much investors are willing to pay for each dollar of a company's revenue. And so a price to sales of below 1 might suggest that a stock is undervalued. And as we can see, this is well below most of its competitors. So this is a good sign. And then we have price to cash flow listed next. And if we remember, price to cash flow is stock price divided by cash flow per share. And so with a 9.62 P to CF, this means that investors are paying $9.62. They're paying $9.62 for every $1 of cash flow the company generates. And then we can head on down now into see if we can find price to book. Sales growth. Seriously, not have price to book. So unfortunately, it wasn't on Schwab's website, so I had to look it up. And their price to book is pretty much about 2. And so remember that the price to book is calculated by taking the market price per share by the book value, and then the book value is just a measurement of companies' assets. So with a number of 2, that means that investors are paying $2 for every $1 of the company's assets. That is the end of this video. What we went over is a bunch of shareholder metrics, metrics that shareholders can use to see if they're paying a good amount of money for the stock relative to that stock's earnings and revenues and expected growth. So thank you so much for watching. And if you have any more questions on any more metrics, head on over to the investing tab on JuniorMarkets website. And thank you so much for watching. Have a good day.